Hi folks, in this video you're going to see the portion I recorded from a live Clubhouse event I did sponsored by QuickBooks, and I was being interviewed by Chris Doe from The Future. The Future, an amazing YouTube channel. I'll put a link below. I strongly recommend you subscribe to that. Anyway, because it was a live club event and we couldn't record the rest of the audience, neither Chris's comments or questions or the audience questions are in part of this video, but I put in text those questions and you will hear my answers. And I hope you enjoy this video. This is a very basic presentation about business strategy, and you will learn about how I think about helping my clients through improving their business or generating a business model for a new business idea. So I start with three very fundamental topics, and I go into various examples that I think you will enjoy. The three main strategies that we're about to discuss today are three levers. Think of your business as a machine and think that there's three potential levers you can push and pull to steer the business in the direction that you want. The three levers or the three strategies we're going to be discussing is 1, your sales volume strategy, 2, your pricing strategy, and 3, your spending strategy. In summary, lever 1, your sales volume strategy, will answer the question, how much do you want to sell? Some people want to have many customers with low ticket sales, and others want to have less customers, more of a boutique practice, and high ticket sales. The second lever, your pricing strategy, will answer the question, which price point do you want to be compared to your competition? Do you want to be known as a low price provider? Do you want to be known as the premium price provider? In summary, I would tell you, you probably don't want to be in the middle. We'll discuss that with a deep dive into that second lever. The third lever will answer the question of how much or how do you choose to invest your time and money? Do you want to take all the profits of the business immediately and enjoy the fruits of your labor? I get if you do. Or do you want to forego that immediate gratification, reinvest back into your business and see that reinvestment 10x in the future? I believe that pushing and pulling any of these three levers will determine the direction your business will take and will ultimately dictate your profitability. So when I think of sales, I'm thinking specifically sales volume strategy. I'm not thinking about it in the micro level, like, we're selling X amount this month or X amount that month. I want you to think about sales as a really, really 50-foot view potential strategy for your business. So do you want to service large wholesale type of clients that bring you a lot of sales, a lot of volume, but possibly lower margin, right? Lower profit? Or do you want to be a boutique practice that focuses more on the attention of detail you give to each customer, whether it's a product or a service, and focus on those large ticket items, cross-selling opportunities, and ways that you can add more value to individual customers rather than focus on just growing for the sake of growth? So when you answer this fundamental question, it will drive your entire business model and strategy. We can look at two very successful, two of the biggest companies in the world, Amazon and Apple. Right? They both have been successful with either sales volume strategy. Amazon wants to solve a lot of little problems for the entire world, where Apple is more focused on the type of customer that would pay more for electronics and are looking to buy a product plus an experience. Therefore, when you go to an Apple store, you get a high level of attention from the salespeople, whereas with Amazon, I love it. I own stock in Amazon. I'm not knocking it. You just don't get that level of attention. So there isn't one good or bad strategy. It's just a matter of choosing where you want to be as a business. Now let's get tactical for a moment. Let's specifically talk about how we achieve, tactically speaking, how do we achieve one or the other? The biggest one, as an accountant dealing with tons of small businesses, the biggest one, the most significant one, is what we call accounts receivable, giving credit to your customers. This is a strategy. You choose this. You choose which way you want to go. Some businesses choose to only deliver the product and service immediately as they get paid. For example, in my world, you know these big tax preparation companies, the ones you see in Walmart and that sort of thing, and standalone sort of retail environments. These professional service firms are literally counting in walk-in traffic. People walk in that walk-in business, they prepare the return on the fly right in front of you, and then once the return is prepared, you pay them their fee, and then the return is filed electronically. Basically, everything is happening in real time. This is a business model. They chose to go this route. Now, there's some pros and cons to this. Some of the pros is that there's minimum risk to the service provider. It is truly the easiest way to transact, right? You don't have to think about doing things prior for the client coming in. You don't have to think about doing things prior from the client coming in. Everything happens on the fly. But the con about this is it relies on walk-in business. In the used car sales world, they call this eat what you kill, right? So as a business, you're constantly just trying to close a deal every day. You're not building a book of business. You're not building a strategy to grow that book of business. You're simply just counting on that walk-in business, right? So that's one type of business, one type of tactic you can choose. The other tactic is a business that chooses to be paid upfront, way before the service is rendered, way before the product is delivered. For example, I make the assumption that in Chris's world, as a graphic designer, because Chris's approach is holistic, is let me understand your business, let's think about branding, let's think about strategy, let's think about the message you're trying to portray, and then we'll get to the logo design. For something like this, you cannot get paid on the fly. You have to get paid up front to do tons of prep work prior to delivering the final product. So a graphic designer, someone like Chris Doe, would collect payment up front. Maybe they collect the entire amount if it's a brand new client they never heard of. Maybe they collect part of it if they already have an existing relationship. That stuff can be managed at the micro level. But as a strategic intent, do you want to force your clients to transact first, to pay you first before you go in and deliver that product or service? The one thing I will tell you from my experience, if you are a brand new business, if you're a startup, you don't have the reputation, you don't have the street cred, this is going to be a lot harder to pull off, right? Because customers are like, well, I don't know who you are. You're not exposed. I don't know how much you have to lose. Therefore, there's a risk element to it. So I think there will be a curve in your business. There'll be a curve where you maybe start taking some of the risk up front by giving your clients credit, and then you shift over to that. Now, some people have been very successful at implementing that up front. I have worked with customers, brand new startups, that have been successful at doing that. But I completely understand the argument that when you're not known, when you don't have a brand, that's a lot harder to pull off. So that kind of moves us to the next strategy, which is actually giving your clients or your customers flexible payment terms. Now, there's a direct correlation. I have prepared 1,000 financial statements for 1,000 different companies in my 12 years I've been doing this. And I can tell you there is a direct correlation between businesses that decided to extend credit to their customers 30 days, 60 days, 90 days, and their overall sales volume. Classic example is you have a small manufacturer, a small distributor of product, and they start selling to the big boxes. They start selling to Amazon. They start selling to Best Buy. For those, they might not have a choice, right? They're dealing with big customers, company policies, they need to pay you later, that sort of thing. Look, I get paid up front from my clients, especially new ones, but a company like QuickBooks, which does contract me to do videos and training programs for them, I don't have a way to force them to pay me up front. I am in their accounts payable system. So I understand that when you go with bigger, more corporate type of clients, you might be stuck having to extend credit to your customers. But what if you're dealing with customers that are not forced in this infrastructure, where you're dealing with a CEO of a small business that can't hide behind a corporate policy, and they can write checks and they can make the decision to pay you up front or make the decision to only buy from you if you extend credit to them. So all I'm telling you is there is a strategy, there is a tactic, whereas you extend credit to hopefully the good customers, the ones you don't have to chase after, the ones that have something to lose if they don't pay you, and getting more sales up front. Now, the problem with this is very capital intensive. You gotta have the capital to be able to pay your employees, pay for your software, pay for your tools, pay for your office space, whatever your fixed costs are, to be able to basically finance your clients' needs by doing this. Again, it's not a good thing or a bad thing. It is a tactic and it's part of an overarching strategy. Chris made it a point that he will not give somebody 30, 60, 90-day credit. I assume that at some point in his life, he has, and he learned the hard way by not getting paid. And that teaching led him to have a stern strategy behind that. And I'm not saying it's good or bad. All I'm saying is you got to make a decision which way you are going to go. Now, there are some specific detailed tactics around this, which is maybe you can do a hybrid, which means you don't extend your client's credit, but maybe you take a credit card payment. A lot of small businesses, when they get started, they forget to set up a way to accept credit cards. And their customers get a 30-day grace period to pay you. So you accept a credit card. Yes, you will pay a fee, but you give your client credit indirectly that way. There are companies that charge one fee, one price if you pay 100% upfront in cash. They call it cash, but it just means, not with a credit card. And there are companies that will charge a different amount if you extend that credit. So yes, I'll take the risk of not getting paid, but you will pay a different dollar amount that will be higher, right? And then you allow your customer to make that choice. You're not the one from a high tower saying you're gonna pay this or you're gonna pay that. You're giving them a choice, and then they are choosing what's more convenient for them. Many times people speak, with their wallets per se. All right, so let's move on to another tactic in sales volume, which is to temporarily lower your prices. So this is a classic thing that you see in Black Friday, after Christmas, this sort of thing. Many companies, both product and service driven, do this strategy. So one of the things that you can do is you can create urgency by releasing a product or a service early, or releasing the capacity to pay the product early and give people a discount. For example, when I release a course, I'm going to teach somebody how to do accounting for a construction company, for example. I know it's going to take me 6 months to develop that course. I can either wait 6 months and start selling the course at full price in 6 months, or I can allow people to buy in early, right? Get into the course early, attend the course as it's being created, and give them a deep discount up front. Number one, rewarding them from being a loyal customer and taking the risk of paying for something that hasn't been developed yet. And two, creating a sense of urgency by putting a deadline per se in that coupon. There's also tactical things when it comes to sales volume, which is to discount your core product. So let's say you have a core product that drives in the business, and then there's attachments per se that can give you additional revenue or additional margin. Classic example is printers. Most people buy printers at cost or very close to cost. Where do they make all their money? In the ink cartridges. So think about your business like that as well. Do you have a core product that brings people into your office? For example, in my world, is tax preparation. Everybody needs a tax return. That's the commodity. The add-on to that is consulting, right? So I charge top for consulting, maybe do the tax preparation at a very low price if we can combine the two things. There's also different things that you see in the app world. For example, you have freemium models where there's a very basic element of your services for free, and you're hoping that the client will buy from you or upgrade in the future. Gym memberships do that, limited time free trials. A lot of thought leaders do this with ebooks. They give away their ebook, and they hope that with that ebook, more clients will come in once they know and understand what that person can do. You can do loyalty discounts or coupons for people that do repeat business. Reward them from buying from you again and again. Maybe birthday discounts, anniversary of the last time they bought from you. All these things you are going to cannibalize your sales a little bit, your profits a little bit, but they could bring more customers in. For example, we got a summer camp for the kids. I wanted to put one kid in summer camp. the camp master or whatever his name was, his title is, he said, hey, if you bring the siblings over, they get a 15% discount. Now, if he said nothing, it is possible that I could have brought the siblings and he would not have sacrificed that 15%. But since he didn't see my intention to buy to buy more than one, then he could potentially extend the amount of sales volume he could bring in by giving that discount for bundling or adding more transactions in the mix. Now, we're not talking about profits specifically. Again, we're only talking about sales volume. Awesome. So let's do a segue into pricing strategy. Okay. Chris alluded to this earlier. You can use pricing as a tool to differentiate yourself and to add flexibility to your clients. But when I think about pricing strategy, I think about price point first and then specific price. So by price point, what I mean is, how do you want to be known or seen as from your customer? Do you want them to think of you as a premium expensive option, or do you want them to think of you as a low price option? Okay, Apple and Walmart, both great, powerful, rich companies. But when I say Apple and I say Walmart, the first thing you think is premium price, not so premium price, right? So again, where do you want to be? Where do you want to be? The number one overarching theme behind this is, typically when companies are in a premium price point, they are more profitable per client, per deal. They are more profitable. But these clients at a premium price point usually invest in two key areas: marketing and innovation. And Chris Doe mentioned Peter Drucker earlier. That's what Peter Drucker says. The business has two functions: marketing and innovation. Everything else plays itself out. So again, I don't think that you should be in the middle. And what's interesting about that is that most people want to start being in the middle. They go out there, they call all their competitors, and they do a spreadsheet average of what the highest is, the lowest is, where everybody is. And in order to want to be fair, because all of us are obsessed with fairness, right? In order to want to be fair, we want to be priced somewhere in the middle. That way we're not too expensive, we're not too cheap, and we can make that claim. And most of us think, especially when you're starting your business, that that's the best way to go. The problem is that you become invisible. You truly, truly become invisible. I think that you should either be known as the highest value because it's the lowest price, or the highest value because it's the highest price, but you deliver a ton of solutions for that client. So a lot of people will lower their price and extend client credit to their customers because they're obsessed with revenue, right? My friend Ron Baker says, revenue is vanity, profits are sanity. And I can't tell you how many small business owners I talk to that fantasize about getting to $1 million in sales. Hector, this year we're going to hit 1 million. Next year we're going to hit 1 million. There's just an obsession with hitting that $1 million mark. And there's nothing wrong with that. I obsess over the $1 million mark as well. As a matter of fact, I still obsess over it. I haven't gotten there yet. But the challenge is that many people make a lot of bad decisions in order to hit the $1 million mark when it comes to profitability. I much, much, much prefer to advise a customer into being the premium, differentiated, positioned as the highest quality, potentially, product versus being somewhere in the middle or the lowest price. Now, I'm going to give you a life hack or a business hack. It's a heuristic that if you memorize these things and you implement them, I guarantee you it will make you a much better pricer and just business owner altogether. One is speed, and I'm going to start very broad and then we'll go narrow. One is speed, the other one is guarantee, and the third one is unlimited. There are 3 words that causes a client to pay more for a product and service. One is speed. How quickly can I get the results after buying that product or service? That's number one. Think of Jiffy Lube. When you get your oil done in Jiffy Lube, you're in and out in 30 minutes. Where you go to a traditional shop, it might be an hour to an hour and a half you have to wait. people will pay 20, 30% more to get it done immediately. Speed. And in today's world, with machines taking over, artificial intelligence, we are now competing against computers. So the faster we can deliver to value, this is called speed to value, not speed to whatever action you're going to take, speed to value. The faster you can get to where the client recognizes the value, the more they're willing to pay. The second one is guarantee, right? People like to know and feel good about a guarantee. If it doesn't work, I can just return it. I can get my money back. Or you can guarantee a result and do it over and over until it gets done right. Now, Walmart, which I mentioned earlier, this is why so many people buy at Walmart and they're worry-free because they know they can return anything. They can return anything, okay, pretty much. And the last one is, we talked about speed, we talked about guarantee, and the last one is unlimited. There's something about the word unlimited, or all you can eat, or all you can consume, that really, really resonates with people. Companies like Netflix, for example, are the complete opposite of Blockbuster, because Blockbuster gave you, I don't know if I'm dating myself here, but it gave you 3 days to return the movie or pay a fee. Whereas Netflix, this just was not their deal. And they went and they evolved to a streaming service, but Netflix competed with Blockbuster on the actual rent a movie deal. But they gave you unlimited time to have that movie. So that word unlimited, inserting unlimited into it, will allow you to be at the largest price point. And I'm going to rub a page from Chris's book, which is, if you want better customers, charge more. Price buyers value money more than their time, and they will go to great lengths to find the lowest possible price. Are these the type of clients that you're going to end up working with? Probably not. With higher prices, you will have more money to spend and invest back into your business, which is a great segue about spending strategy. So let's talk about the third lever, the spending strategy. And I like to call this purposeful spending. And the reason for that is because most people are so worried about spending. As an accountant, I'm a frugal person. My job basically is to help people spend less money, pay less taxes, right? But many times spending can be purposeful, and spending money in the right places will lead you to the right result. I'm going to give you an example. A lot of business owners end up spending based on whether or not something is tax deductible. And that, to me, is the single worst strategy you can think of. I had a client that 3 years ago spent $70,000 in a boat. Okay, it's in the balance sheet of the books. The boat is in the balance sheet of the books. And it was a new client for me. I asked him about it. He's like, Hector, don't ask. I asked 3 different tax professionals, and they told me that I can use my boat to take out my clients. And that's what I do. Therefore, I deduct all my boat expenses as a business expense. While there is some adjacent truth to this, in other words, it's not completely implausible that you could take a client on your boat and call it a corporate event and it will be 100% deductible. That is very, very true. But if I was that client is a custom furniture manufacturer, I would have spent the $70,000 in an upgraded CNC machine, right? Their employees are all complaining that their machine is from the 80s and it takes them forever to produce the product. So I would have, within the same potentially tax efficient purchase, spend the money in reinvesting it back into the business. It's the same expenditure, but it's a lot more purposeful. Now, I know a CNC machine is not as fun as a boat. I get it, okay? But you're a 39-year-old entrepreneur. You can wait for your boat. Build your enterprise first. Build a sellable business. Build a business that doesn't require you to be on it doing quality control 24/7. If you can purposefully spend the money in empowering your employees, giving them better tools, upgrading your infrastructure, you are going to have a much, much better business. And one also little tax hack here, you can get potentially 100% deduction via Section 179 by making a big expenditure like a big piece of machine, even if you didn't pay for the entire thing up front. If you finance a machine, you bought a machine on December 31st, 2020 or 2021, and you put it in service that day and you financed it, you had zero cash outlay. you could potentially get the entire purchase as a deduction. So I think that's a much more purposeful type of spending and potentially equally efficient. The other part of purposeful spending is you gotta have a good accounting system. You gotta have a good bookkeeping system. You should invest in an accountant. I know I'm being self-serving here. You should invest in a bookkeeper, and you should keep track of your expenses. A good accountant and a good accounting system can spot patterns where there's unnecessary spending. It is incredible how often I look at a $25 a month payment, some random subscription, where I ask the client, hey, what is this $25 you're paying? And they say, I don't know. Well, my take is, if you don't know what it is, you probably won't miss it. Let's call and let's cancel it. But if you're not paying attention to your numbers, you will notice how many expenses are happening, and you're not noticing that. So without an accounting system like QuickBooks or a great bookkeeper and accountant, you probably will miss out on this great opportunity to spend less money and then reinvest that money again back in your branding, back in your business, back in your employees and your tools. The other low-hanging fruit tax strategy is setting up an S Corp and setting yourself up for payroll as a business owner. So many small businesses, they heard of the LLC and they say, I'm going to set up an LLC. And they get no tax advice. They don't do the research. They don't understand what it does. And at the end of the day, the LLC most of the times provides zero additional tax value. So the S Corp, right, will probably most likely be the most tax efficient way to do this. But again, you need to educate yourself on this stuff and work with your accountant with that. The last one here is education. Education is a really important aspect of purposeful spending. So many of my clients tell me that they don't want to invest in educating themselves or their employees. I'm not talking about college degrees. I'm talking about investing in practical skills to make their jobs better so they can be more efficient, more effective. Many of these clients, when I say, hey, you probably should invest in your team, they give me an answer like, well, what if I invest all this money in education and then they leave me? And for that, I say something I learned, I'm mentioning Ron Baker again, something I learned from him, which is, what if you don't invest in them? What if you don't educate them and they stay? And think about the ramifications that has even for yourself as an entrepreneur. If you are the money maker, you are the rainmaker, you are the one that brings in all the sales and closes the deals and does the work and quality control the work, whatever it is, and you are not improving yourself and educating yourself, and you're staying in the business. So think about that. Education is another part of that. And I got a couple of more, but I think we need to possibly move on or open it to Q&A. So Chris, maybe let's start bringing in some conversation. So sales volume, where do you want to be? Do you want to sell a lot to a lot of, you want to sell a lot to a lot of customers, little tickets, low value, low profits? Or do you want to sell big tickets to less customers, more boutique, more attention to detail, high value? That's lever number one. Lever number two, pricing. Not so much the specific price of the product, price point. Do you want to be the low price solution? Do you want to be the premium price solution? And the third level is spending. You can spend in things that will make you more productive. Spending is not a negative thing. Paying tax is not a negative thing. Usually paying tax is a result of a profitable business, but you want to have a strong system in place for that. That's the summary. Those are the three levers. Any advisory engagement that I do with my clients where they say, Hector, help me make my business better, we fundamentally start at those three, and everything stems from those three. Yeah, so you mentioned pivot, and of course, this ties to both innovation and innervation. This is from Rory Sutherland from that big branding firm, Ogilvy. That's right. So Rory Sutherland wrote a book called Alchemy, and he talks about intervention. And I've seen so many clients do this concept of intervention where they're not transforming the business, they're just changing the frame around it. And I'll give you an example. I have a client that has had a restaurant. they got shut down, or not shut down, but they got significantly reduced at the amount of clients that they can serve. He went to his supplier where he buys paper and napkins and all that stuff. And he said, how many toilet papers can I buy, for my restaurant? And they told him, well, because of the situation, you can buy X. And he bought every single toilet paper he could from his supplier. He went on Facebook and said, hey, come pick up your order and get a free pack of toilet paper. Again, you don't want to think of toilet paper and food and restaurants all together, but right now his sales are higher than they were pre-pandemic because he touched a point. This is innovation at its best, right? He used the situation with toilet paper and say, I understand you can't find toilet paper. Hey, I'm going to reward you. I'm going to get you a little 4-pack of toilet paper if you pick up your meal from the restaurant today. Another way to do this type of innovation is to frame what you do to speak to people's anxiety. So think about the product and service that you sell, and then think about your sales pitch starting like this. Look, I know the pandemic affected you, affected us. Because of that, we now offer this service plus XYZ. And that XYZ is the solution that calms the nerves of the clients. Now, this could be a product at a smaller price point, more of a do-it-yourself type of solution. This could be a product that also increases the level of safety. I remember that in Uber Eats, they added a little checkbox that said, drop it off at the front door. And I was seeing some stat that after they added the checkbox, drop it off at the front door. So don't physically hand it off for me, drop it off at the front door. They saw an immediate boost of 10% in sales. So little things like that you can address the concerns of your clients, which is the reason why the pandemic affected people, is mostly people were worried. You can address these things really quickly, innovate, and without having to pivot your entire business model. So I'll jump on that. So this concept of this whole concept of subscription, right? Anytime you add as a service to something, it will potentially expand your horizon in terms of how much more clients you have. But the only way to sort of automate your sales process or your product delivery process, going back to toilet paper, there was a company that was selling toilet paper as a service. You subscribe to toilet paper, and every month they deliver X amount of toilet paper to your house. Again, they're addressing the specific concern of the times, but they basically made it into a subscription. So in order for you to do that, you have to productize. That means that you have to turn your service into a product somehow. Now, it doesn't mean that you will stop servicing your clients in high level of detail. It doesn't mean you stop adding value to them, but you start automating certain parts of the business. Maybe the inboarding process, the onboarding process, maybe you automate the communications through apps and that sort of thing. So there are ways for you to automate certain things in the back end. There's tons of applications that integrate with QuickBooks and that sort of thing. You got apps like Zapier that can automatically get a trigger from one place and send a welcome email or instructions email to your client. So you could increase the number of clients you have simply by productizing and automating. And that requires you to continue to deliver value and serve your purpose based on what your business was meant to do or meant to be. But it also requires you to rethink on how the mechanics and the inner workings will change the delivery system of it. Thank you, Brian. Okay, so I have a video in my YouTube channel. It's 20 minutes long. That will answer your question in a more deeper way, but I'm going to give you a quick answer. Typically, businesses are paying between 0.5% to 2% of their revenues in accounting. Now, this is a little bit challenging for people getting started because they are pre-revenue or they have very little revenue. And the work that the accountant needs to do, such as helping them set up the LLC, convert it to an S Corp, setting up payroll, setting up your client, your customer list, all that stuff into QuickBooks, that stuff is a lot more labor intensive at first. And it's hard to make that direct correlation between revenue and the cost of an accounting or bookkeeping professional. So that percentage is more for mature businesses. For people getting started, first thing I would ask the accountant is, how much can you help me get my business up and running? Ask that question and see if the accountant is just going to say, well, I can only do your tax return and that's it. Or, you know what? I like your business. I want to see you succeed. I am going to go this route, this route, this route. I'm going to help you set up QuickBooks. I'm going to help you set up your LLC. I'm going to teach you how to use it so you know how to invoice. I'm going to help you set up payments. And if you are to get some help at that level where you're being taught how to run your business, I would be okay, even if it's a lot more money than what you have, spending a good $1,500 to $3,000 in an initial engagement to have that accountant completely get you from nothing to systematized within the first 6 months. So unfortunately, accounting is expensive, period. Unfortunately. But if you find an accountant that likes your business, likes your idea, likes the value proposition you're bringing, and in some cases they want to be associated with your brand. That's very true. I want to be associated with many brands. I would do Chris those tax returns for free if you would allow me. But that type of connection. It actually speaks louder than the actual monetary cost. And some accountants today are getting creative and saying, you know what? I'll take 5% of your business and I'll be your CFO and I'll do it at a reduced price. So you can experiment with things like that. But yes, expect to spend between $1,000 and $3,000, in the first year to get you completely systematized. Oh yeah, I got a DM here through Twitter and somebody asked me, Hector, where would you spend money on? Sort of like, maybe they like the fact that I talked about purposeful spending. So I'm going to give you, I would say, the biggest life hack, or one of the biggest life hacks. 2 monitors. It is incredible how many businesses I walk into and people are working with just 1 monitor. And I go to the business owner and say, why are your employees working in just 1 screen? And usually I get a shrug and I don't know, they never ask for it. But I still walk into their office and they themselves, the owner of the business, has 2 monitors. And I ask them, why do you have 2 monitors? And they say, well, it makes me a lot more efficient. Okay, how much more efficient? Well, 20 to 30%. Imagine that times 10 employees. Hello, $200 you could spend and instantly boost productivity by 20 or 30% per employee. So it doesn't require a lot of money sometimes to do that. And you can ask your employees, hey, and literally say it like this, what small expenditure can I make that would boost your productivity by 20%? And some people will say, a more comfortable chair. And I got to tell you something, a comfortable chair versus an uncomfortable chair will drive more productivity and it will drive just happier employees. So little things like that sometimes go a long way. So I would start with exactly what Chris told you before. Try to get your clients to pay some or all up front, even if you were to give them a discount. Absolutely, I would say that's probably your biggest one. The second one would be to, again, I know Chris doesn't like receiving credit card payments because of the potential chargebacks, but accept payments with a credit card, because you're going to have, look, there are people that spend with their American Express or whatever just because they get the points. There's some weird psychological element to getting points that drives people to spend more money. Something else you can look at is you can look at these finance companies that allow your customer to finance your deal. Okay, there's a lot of companies out there. They're called Bill Me Later. Just Google Bill Me Later service or something like that, or Bill Me Later financing. And you can bring in an option for the clients to pay for you to get paid up front. You will take a huge hit, 20, 30%, because these credit companies are taking the risk, but you get paid all up front and your clients get flexible payment terms. And like Chris said, giving the clients that flexibility will afford you to be able to raise your price a little bit. So by raising your price and giving clients this flexibility with a buy now, pay later type of thing, that percentage that you're paying to these companies that allow your clients to finance your deal might not be as big of a hit. So the one I mentioned before, and I want to repeat it, is take a look at your subscriptions. There are so many things that we're paying that we should not be paying for. And you can try this exercise. Cancel it for a month. If you're still there, if you're still alive, you didn't need it. And then try to figure out how to run your business with less money. One thing I learned from a book called Profit First is if you take money away from your bank account up front before you spend it, you are less likely to spend it. Think about a tube of toothpaste. When your toothpaste is full and brand new, your toothpaste will leak and fall into the floor and you wouldn't even touch it. That's disgusting. But when you have one little piece of toothpaste, you will scrape that thing off the floor because that's the only thing you have. So try to make your ends meet. Try to make ends meet with less money. Take away some of that cash and ability to spend. And if you have to pay on credit, if you have to get a credit card, invest in things that produce income. Focus on that. When you buy something, you buy a new computer, a new microphone, a new car, whatever, you think, is this asset going to help me produce more money? Is it going to bring in customers? Is it going to help me to double my capacity? And if it doesn't, move on. I'll answer that real quick. So from a specific example, I joined a group that Chris has called the Pro Group, which has an X dollar amount per month and allows Chris to do a one-to-many type of coaching. It's not a one-on-one coaching, but a one-to-many type of coaching. I do the same thing for my clients. People want to pay me one-on-one for QuickBooks training, but they need 10 hours of training or whatever. And this is probably going to get to $5,000 or more. And not everybody can do this. So instead, what I do is I offer a one-to-many type coaching type service where maybe 3, 4, 5, 10 people are being taught one generic concept and they're given a small period of time where they could ask this sort of one-on-one question, but my entire attention is now focused into one. So offering the one-to-many type of advice helps a lot. I'll give you a different one. I used to work for Best Buy. A long time ago, I used to work for Best Buy, and we launched the TV installation service. You could pay $500 to get your TV mounted in the wall physically on your house, or you could pay $50, come to a course where we give you the kit, we give you the mount at a discounted price, and we teach you how to do it. And we had 20 people in there that were all taught how to mount their own TVs. Out of those 20 people, 2 decided that it was too hard for them and they ended up hiring us. But you gave everybody a choice. Full attention, partial attention, still the same quality, the same value. So that's how I think you can multiply yourself. I think the simplest one is to just be 100% clear with your customer that you are in a commodity type of business and you're reselling a commodity. The one thing I would say is I would couple that with the good news. I would say, good news, you can buy a larger volume from me today and possibly hedge a even higher increase upfront in the future. But a sudden market change that forces you to pay more for your raw materials is bottom line going to give you that issue. So I think it's important for you to go back and take a look at your core costs and find and just make the assessment if these things are susceptible to market changes, and tell your clients up front before doing that. The other thing you can tell your client is say, look, client, I'm sorry I didn't tell you. I'm sorry that you assumed that this was going to be the price forever. I am willing to maybe pay for the first month during the price transition. Bite the bullet, but it will be a great service for you to do, and it will buy a customer for life. You can turn a negative into a positive by taking a little bit of risk up front. Bye. Thank you so much, man. Thank you, everybody.